Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, we'll work through today's market meltdown with JB Ware's Mike Kendall. Marcel von Pfeiffer from Arminius Capital will tell us what global factors could be responsible for our stock market volatility. We'll see how an experienced market watcher like Morgan Simon Bond is playing the market at the moment. And with superannuation in focus ahead of next week's budget, our resident super expert Tony Negline will tell us what to watch out for, and we'll get a check-up with our media medico, Dr. Ross Walker, to see what we should be looking at when it comes to complementary medicine. Stay with us for the next hour and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to Switzer at switzer.com.au. You can follow me on Twitter and the handle is @PeterSwitzer. Okay, so our beloved dividend stocks have copped a battering today. Well, I see this as nothing but a buying opportunity for the kinds of stocks that we should have in our portfolios. Sure, their share prices have spiked nice and high in recent years, but these stocks are beautiful for dividends, and capital gain is just a nice bit of cream on the cake. And in recent years, the cream has creamed it, to create a pretty lame pun. But in case you have the wrong idea about dividend stocks, have a look at this chart which shows why my dividends are more reliable and more important for building wealth and giving a good stream of income than good old term deposits. So let's have a look at this chart. Okay, so what we've got here is $100,000 invested back in 1980 going right through to 2014. Now, $100,000, this line here, these little blue lines, charts, bar charts, they are what you're getting on term deposits. This is basically what you're getting over time. You can see it's a pretty well straight line when it comes to term deposits. But look at dividends. They grow, they get bigger and bigger. Look, 2008, that was a GFC year. Look, it was good, fell away in 2009, started creeping up. Effectively, if you'd rolled $100,000 into really good quality dividend paying stocks, they're paying around here, look, about $80,000 after all this time. But good old term deposits, they keep on giving you $5,000 or $6,000. So I think there's a pretty good case that term deposits are very ordinary when it compares to dividend-paying stocks. So so the summary is, when you think it through, looking at that chart, the trick is to build up a cash buffer that can ensure you don't have to eat into your capital in bad years. But once you do that with dividends, will be more and more reliable and lucrative than term deposits. By the way, in case you haven't done the figures, the yield on a CBA share is now 5% before you add the franking credits. And if you bought a CBA share at $40 a few years ago, your yield is 10% plus franking credits. Dividends kill term deposits, so make sure you retire dependent on dividends and be happy to get greedy and buy dividend-paying stocks when everyone is fearsome, just like now. Now, we're going to Mike Kendall. Madness and mayhem prevail on the stock market today, but how worried is Mike Kendall? Let's find out. Mike, how are you?
Good evening, Peter. Well, I'm doing well, and I'm pretty much thinking along the same lines as you at the moment. I think there's a bit of opportunity.
Oh, without a doubt, Mike. Isn't it funny? I keep hearing, really respected people in the business, particularly political, economic area, saying how it's terrible about term deposits. But the reality is, so many of our retirees should have been encouraged to go into good dividend-paying stocks years and years and years ago.
Oh, look, I agree. And I think the thing to keep in mind is if you are, and a lot of them already have been invested in the equity market, Peter, is not to get disturbed about what we're seeing in equity markets just at present, particularly on days like today. We've seen it consistently over the last 3 or 4 years. Markets have inflection points, things pull back, and they've always proved time and time again is the best time to step up to the market. You'll never actually time entering a stock like CBA to perfection, but you could be pretty sure you're buying one of the very best companies in Australia, as with most of the major banks and the big blue chip stocks, and a lot of them got sold off today. Hold them for 3 to 5 years, you'll do nicely with a good dividend flow along the way.
Yeah, the interesting thing is I was talking to David Murray last night, and David is someone who thinks that people have to be very careful with their retirement. And I said, in fact, your very listing of CBA shows how valuable dividends are compared to term deposits. benefits. If someone had put the money they could have put into CBA back in 1991 or so when it listed, well, that dividend has gone up like 45 degrees, and term deposits have basically been a straight line around 5 or 6%.
Well, look, and I think they're good lessons for investors to keep in mind. You don't have to be the most sophisticated investor in the market, and you don't have to be overly alarmed at these dramatic moves, which I think in the main, Peter, today have really been driven from the institutional part of the market, and I suspect from offshore investors, maybe more than domestic investors. There's a lot of uncertainty in the last 24 to 48 hours in the domestic equity market and what's happening in Australia. And when you get these inflection points where there's a bit of uncertainty around, opportunities do open up, and I think for the careful and the cautious, some selective buying in good quality names, you'll do well over time.
Let's talk about the CBA result, Mike. What do you think about?
Look, like the rest of the market, a bit of disappointment, but there's been a lot of news out on the banking sector this week, and NAB's due to report their result tomorrow, Peter. So, you know, all in all, 2.2 billion profit for the quarter isn't too bad, but the market was looking for more, and I think people got nervous because some of these bellwether stocks, like your Ramsay's, your CSLs, and now we're seeing from CBA, but more particularly in the banking sector, that you know, maybe business is becoming just a little bit tougher, and these stocks are priced for perfection. So the minute there's a sign of a shadow or some sort of inflection, you will see some traders hit the sell button, which is what we saw today. Overall, you know, obviously there's rising cost pressures. You know, it's pretty competitive out there across the four major banks to win business, and I think those things are starting to creep in. We saw that with Westpac on Monday as well. ANZ seems to be flying between the two, but overall some uncertainty at the moment. The banks have been running pretty hard, and you're going to see people take a bit of profit, and that's what we've seen over the last couple of days.
Okay, so Woolworths, is it getting in the buy zone, Mike? They're giving a bit of a shellac, and it'll probably cop it again tomorrow, but is there going to be a stage where you say, oh, this is pretty good value for Woolworths?
Look, I think it's getting close. Look, I've been a big Woolworths fan and probably been long and wrong for about the last 6 to 12 months, but it is, you know, the largest retailer in Australia. They've got a lot of smart people there, but I wonder if this game's got a bit longer to play out. Obviously, the market not impressed with what the company's having to say today about turbocharging their cost reduction strategy and that they'd lost sight of the customer. You know, a few question marks on, well, these things should have been obvious to the company for some time, and what are they going to do about turning this master's business around? So I think a few question marks for Woolworths at the moment, Peter. So I'm a little bit gun-shy of stepping up, but gee, it's starting to look attractive. But it is a quality franchise with great businesses, but maybe it's going to take another 6 to 12 months for us to really start to see them turn this ship around and get it moving the way the market wants to see. Okay,
another bid for iNet.
Well, we saw TPG come through and up their bid. I understand the board of iNet this afternoon, Peter, have come through and recommended that bid. I think it's about 20 cents or 25 cents higher than the bid from M2 Communications. Whether they're going to come through with a topped-up bid, but I think this bid got the green light from the board of directors of iNet because it's got a share component this time, and the previous one did not. So I think there might be a little bit more to play out on this. Be interesting to see what moves M2 make from here.
What about realestate.com.au, mate? That was a bit of a clobbering today, wasn't it?
Well, look, it was. It got hammered, and again, it's another example like CBA, CSL, Ramsay, these stocks that have been priced to perfection. The minute there's a bit of a chink in the armour, you see the sellers come out pretty aggressively and lock in their profits. And sometimes you can get a little bit left wondering what's happened. But overall, look, the profit result was up 13% today, Peter. Or 14%. The market a little bit disappointed. This missed market expectations, and they're wondering whether they're starting to see a slowing in the business. It's been one of the market darlings probably for a good 3 or 4 years. From time to time, these top quality stocks do run into a bit of trouble in the market, and you see some aggressive moves. Look, I wouldn't be overly concerned. It's still delivering, you know, 10% plus profit growth and sales growth, but the market had been pricing it maybe for 20% plus. So you're going to see it marked back a little bit when they don't hit the market, and that's what we saw today. Yeah,
and we keep hearing that Domain is actually doing a better job than it was, say, 3 or 4 years ago. So it kind of makes sense, doesn't it?
Look, it does, and that's reflected in the Fairfax share price too, which has been moving a little bit.
Okay, one final thing, you know, talking to all your pointy-headed research people around the office, were they kind of annoyed that Glenn Stevens dropped that easing bias reference, because it has been important to see the dollar go up, hasn't it? And a lot of the foreign investors wouldn't have liked that dollar spiking.
No, well, I think it upset quite a few people, but I think I wonder whether that was to try and cool things down in the property market. But it's bizarre, Peter, that just a couple of months ago we got a 25-point easing and the market flew and the banks went for a big run. This time we get a 25-point easing and it's completely the reverse. So there's a lot of uncertainty about where we are in the market at the moment and where we are in the Australian economy at present. So, you know, bond markets are moving. You know, the currency's moving. We're seeing the commodity prices start to shift around. A lot of people aren't sure where things are going to play out when we've got these low interest rates. So when there's uncertainty, people will move to cash. And I think that's what we've seen today.
Okay, well, we have said in the past, selling May and go away, but May's not over yet, is it?
Well, certainly not, and maybe that's more an institutional play. As you said up front, Peter, you know, it starts to open up opportunities for private investors that are looking to build their super funds or have got excess cash or are a bit upset with their term deposits. So be selective, but certainly have a good look.
Great, mate. Talk to you next week.
Thanks, Peter.
That's Mike Kendall. After the break, we'll check out just how worried Marcel von Pfeiffer is about today's sell-off and what's going on in Europe.